Good afternoon, this is Bob Iaccino coming to you from the CME Group trading floor in Chicago, talking crude oil futures. Crude oil futures actually initially popped this morning, going up to two-year highs, but it may have been an overreaction with crude finishing just under -1% on the day. Again, we shot up to about 52.43, approaching the 52.50 level, came off from there, went down well below $52. We've got these individual dollar and $1.50 and 50-cent psychological levels, which really don't mean a whole lot. But again, that initial pop this morning sold off pretty quickly. Now, when you look at a chart, it won't look like much more than a blip. It almost looks like an unchanged day, but we are actually down close to 1% on the day. Now, there was a Kurdish vote, a Kurdish referendum that happened over the weekend that basically the Kurdish people, with an overwhelming majority, 90%, voted for independence from Iraq. Now, Kurdistan is the northern region of Iraq. It is part of Iraq, but the independence vote actually brings a problem, brings about potential instability to the region. And this is a region that actually has been surprisingly stable, especially since the OPEC production cuts. We've had some ongoing things in Libya and some things in Nigeria, but other than that, overall, the OPEC region, which produces Brent crude, has actually been fairly stable. Now, this kind of a vote could bring instability to the region. It's not the kind of price spike that OPEC wants. OPEC wants a sustained price spike. Now, why would this bring instability? Well, the Kurdish region of Iraq produces about 10% of Iraqi production, total production. That's about 400 to 500,000 barrels a day. A lot of that crude oil goes through pipelines in Turkey. Now, Turkey is against this independence vote because both Turkey and Iran are worried that their Kurdish populations will seek the same independence. So they're against it, and actually Turkey is threatening to cut off relations with northern Iraq and shut those pipelines off, which would slow the supply of Brent. Brent actually spiked, and the Brent price is actually causing WTI crude oil, which is what we trade here at the CME Group, it's causing that demand to increase. It's making it more attractive. The spread between Brent and WTI really dictates whether the U.S. imports or exports the oil or not, because you have to add transportation costs into that. And as we've gotten more and more lax in our export policies for carbon fuels, we're able to export refined product, not necessarily unrefined product, but that's been eased up quite a bit over the last few years. And those imports, we expect those to jump because, again, the spread between crude, Brent and WTI has actually expanded quite a bit. Now the shipping costs for WTI to get to these regions across the Atlantic can now be factored in. WTI is still cheaper. A lot of crude oil is not fungible, but the main bunch between Brent and WTI is fungible and can be refined into the same product. So the demand for WTI looks to be strong. So we do expect the bid to stay in WTI, which is what we've been talking about for weeks now. This is Bob Iaccino talking crude oil futures from the CME Group trading floor in Chicago.